Okay, hi everybody. Hi internet fans and friends. I hope you are doing well. We are in the middle of a coaching session here in the Strategic Day Trader room, and we are, as we are doing this lesson series in the Strategic Day Trader room, and I am sharing it with you all. We are on lesson number 4. We started off with basic stuff, and we're still, I would say, in the in the section that's still on basics. But that's the most important thing, by the way, because that's the foundational stuff, right? All else is built upon. So we did lesson 3 last time, and we talked about reversals and pivots. Uh, and let me give you a quick recap, and we'll move on to lesson number 4 today. Okay? So we talked about how reversals happen, and we said that when we're measuring the potency of a reversal, we look for mainly two things. Number one is the size of the reversal. The size of the reversal. The bigger it is in relationship to the thing that it's reversing, to the bar that it's reversing, to the prior move that it's reversing, the more significant or the more potent it is. So the larger the reversal bar is in relationship to the prior bar, the more potent the reversal is. And then the other thing we look at when we're assessing the significance of the reversal is the depth, the level or depth of retracement into the prior candle increases the potency. So in the first example here, we say it was really potent because not only did we reverse this bar, we actually went way below it. So we reversed the entire bar, and we reversed about, it was a 200% reversal. It wasn't like a 50% reversal or a 25% reversal, right? Right here. It was to a 200%, a complete negation plus more. In the case of the last circle here, notice we started to reverse the green bar, but we only reversed a little bit of it, so not so potent. As the size and the number of candles that make up a reversal increase, so does the potency. Okay? And that's why from left to right is more potent. We said the first couple of candles, even though we reversed about 100% of the green bar, almost, or 80%, it still wasn't significant because these were very small bars. That's like two traders playing with themselves. So it wasn't a big deal, a small battle. Over here, it's a war. I mean, that's a big battle. So a big green bar, and then it's completely reversed by an even bigger red bar. And then in the fourth example here, it's even more bearish because the stock attempted to go higher and then it got rejected, resulting in a topping tail, which topping tails trap people. Topping tails form because form when the stock rallies and then that rally is immediately rejected. So it gives people not much time at all to get out. Gives them very little time to get out. And that's why this was the most bearish. But to tell you the truth, it depends on the time frame, it depends on the picture. This was pretty bearish. That's pretty bearish. And the third one is really bearish, except that the green bar we were reversing wasn't so big. If the green bar was a little bit bigger, then I would say that's pretty bearish too. Now, we talked about reversals because also reversals is how pivots form. And pivots, a low pivot is an indication that buyers took back the control. Sellers were in control. That's why we got red bars. And then now the buyers are in control, right? The way to get a pivot is a low pivot forms whenever you have a higher low on either side of a candle. So if you have a bar with a higher low on either side, then you get a pivot, right? A high pivot is indicative of sellers taking back the control from the buyers, overwhelming the buyers, and when we get, in order to get a high pivot, you have to have a lower high on either side of a candle. Now, not all pivots are created equal. That's why we also can measure the potency of a pivot, right? The number of green, the number of higher lows on each side, the more higher lows, higher bar lows that is, on either side, the more potent. The number of higher highs, the more also higher highs. This bar is higher than the prior bar, and that bar is still higher than the prior bar, and these are the lows. So the more higher highs, higher lows, the stronger the pivot, the more secure, the more no wishy-washiness, right? That's what it means. The more consistency there is, the more firm it is. Um, we also said that the right side of the pivot is actually more important than the left side of the pivot, because the right side of the pivot determines, that's the group that's taking back the control, whether it's the buyers or the sellers. If it's a pivot high, then it's the sellers. If it's a pivot low or a low pivot, it's the buyers. That's the more important side to examine and really pay attention to. Okay? And then we said if the candles are consecutive, if the higher highs and higher lows are consecutive, that's better, versus here, these are not consecutive, higher lows. And then if the candles are big, the bigger, the more money that went into them, most likely, because big bars, if you notice, form on big volume most of the time. And in addition to all of that, the deeper the V, the more powerful it is, because the deeper the V, the faster the retracement, the faster the reversal. The faster the reversal, the more people trapped, the less time people have to get out of the stock before it actually reversed. So in this case, the shorts get trapped. So the deeper the V, the more likely it is a bottoming tail on the larger time frame. The more likely that it actually forms a large bottoming tail. Large bottoming tails, deep V's, V pivots, those you and I don't create. It's big money that creates them. Look at any sharp V pivot that you can find, and just on a liquid stock, any liquid stock, and just look at the amount of volume, the shares that went into creating that reversal. You'll be astounded. It's like in the millions. If it's on a stock like Apple or Amazon, or it'll be in the tens to hundreds of millions of dollars that went into that stock at that moment in time, within, let's say, 5 to 10 minutes, that formed that reversal. It'll be a staggering amount. Your jaw will drop. So you and I, and the day traders out there, don't create these kind of pivots. It's the big institutions. So that was all last week. This week we're going to talk about trends. I actually wanted to talk about reversals, pivots, and trends all in one lesson last week, but ran out of time. So this is like lesson 3, part 2. So I'm trying to kind of, it's a lesson series that you need to really watch it from the beginning. So because I'm building each lesson is built on the previous lesson. That's why I give you a recap. Every week I give you a recap of the last lesson. So we talked about pivots, and pivots, so reversals form pivots, and pivots form trends. So that's how they're connected. Reversals form pivots, and pivots, reversal bars I should say, form pivots, and pivots form trends. Now we only have 3 trends actually. The price of a stock can only go up, down, or sideways. The uptrend is defined as here's the criteria: higher highs, higher pivot highs. So this pivot high, it was higher than the previous one. This one was still higher than the one before it. Higher pivot lows, right? Higher pivot lows. A rising 20 period moving average, a rising 40 period moving average, and relatively even space in between the two rising moving averages, which is what we call RR, railroad tracks. So that's the 5-point criteria for an uptrend. Okay? On smaller time frames, the 8 or the 10 period moving average can be used rather than the 40. Rather than the 20 and the 40 for day trading, I use the 8 and the 20. For swing trading, larger time frames, you can definitely use the 20 and the 40. I wouldn't use the 8 MA on daily, weekly, or monthly charts. Just on the smaller time frames, I use the 8 and the 20 to create that railroad track, or the 10 and the 20. Here's the important part, is once the above uptrend criteria is met, the T3 trader's sole objective is to buy every single dip or pullback and break out in the stage 2 uptrend. Not one should ever escape the T3T. Okay? So your job becomes to buy every pullback to the rising 20 MA. Or if it sets up as a breakout, that's fine too. You can scan your trading universe to make a list of stocks currently trending in powerful stage 2. Stage 2 means an uptrend. Okay? Stage 2 means an uptrend. So far we haven't shown you any real charts. Here's a real chart. And note the smooth nature of the 20 MA and the 40, which creates the railroad tracks. You don't want a 20 MA that's going a little like sideways, right? Or really sharp 20 MA. You want a 45 degree. You want a moving average that goes from the upper left corner of the chart to the upper right corner of the chart. If your chart is square, that should give you exactly 45 degrees. So you want a 45-degree 20 because that's the trend that's sustainable. If it is a lot sharper, then it's not sustainable. It's really powerful, but those are the ones that go climactic and exhaust themselves, and then they tank. If it's not trending enough, it means it's not in a nice fluid uptrend. It's not in a strong uptrend. So you want the 45 degree. All pullbacks are buyable in this case, or breakouts. If you get a breakout off of the 20, you could say that was a breakout, right here, stop right here. Notice if you keep your stop on the other side of the 20, you almost never stop out. Almost never stop out. When you do, the trend is over anyway. You want to be done with it. We were talking just a little bit ago. We were talking about X, right? How when you have I don't have the 8 on this because I just don't. This is a daily chart usually, and now it's a 5-minute chart. But look at this. That's the trend that we're talking about. Foot Locker today also. That's the kind of trend we're talking about. If I had the 8 and the 20, you'd see the railroad tracks. But I don't have the 8. Okay, great. Here's another example, right, of an uptrend showing the letters indicate the higher highs. Notice how they're consecutively higher. So E is higher than D, D is higher than C, C is higher than B. There was another pivot here, and then here, right? And then the numbers also. I guess we're not showing you 1, 2, 3, 4. They're all consecutively higher than the prior trend, than the prior pivot low. And then the downtrend is exactly the same also, but to the downside. Instead of higher pivot highs and higher pivot lows, lower pivot highs and lower pivot lows. Notice the circles. Each is lower than the prior one. And then notice the lines here. These are the pivot lows. Lower pivot highs, lower pivot lows. A declining 20, a declining 40, and railroad tracks between the two. Downtrends are also known as stage 4. Why? Because we have that basic unit which has 4 stages, and so that the downtrend side of the trend of that basic unit is called stage 4. Okay? On smaller time frames, as we said, the 8 and the 20 can be used to see the railroad tracks. Once the downtrend criteria is met, the T3T's sole objective is to sell short every single rally and breakdown, depending on what the stock what the stock is giving you. If it's giving you a sell setup, then do the sell setup. What's a sell setup? A sell setup is when you have 3 or more higher highs, in this case bars, or green bars, to at or near the declining 20. So let me just show you real quick. Those would be sell setups. If the stock was to base, go sideways, that would be a breakdown. When you get a rally into the declining 20, you can actually short just under the last bar's low, stop above. This is a pretty sloppy chart, but it still works. So the moment the prior bar's low is broken, that's your entry short. Short, stop. Short, stop. Short, stop. I don't see, these are not very good here. You need 3 or more usually. See how we got 3 right here? But the truth is, the most important thing when it comes to a downtrend is the location. So even if you don't have 3, in this case we had 3, but even if you don't have 3 green bars in a row, as long as the entry is forming at or near the declining 20. Why is it the most important thing? The location is because you know the trend is not going to fail. If you can put your trust in the trend, then you'll make a lot of money, because you just put your stop on the other side of the moving average right here, and it never gets taken out. It just continues and continues. If you look at the stock like Foot Locker, we were just discussing it before I turned on the recording. See this? I mean, if you just put your trust that it's gonna hold, then you could have actually captured the majority of this trend. Something like the Foot Locker or the X. Now, we are in a slow market environment right now because we're just starting earnings season. In fact, it starts on Thursday officially, but it doesn't really get going until sometime next week. So we'll start to find these every single day from gapping stocks, every single day, because gaps create big moves like this. That's what I do. That's what I focus on, is gaps. Question, do you enter the pullback at the 20 or break of the bar that touched it? A break of the bar of the prior bar's low. So as soon as I get a break of the bar, so here, not at the 20, blindly at the 20, you can. I often say if you don't have a sell setup, you're not sure where to get in, fall in. Fall in. You know how when you trip, you fall in. You just fall into the stock. As long as you put your stop on the other side of the 20, you should be fine. Should be fine. Sometimes you may get stopped out, like here, but notice it wasn't yet a power trend. It wasn't a 45-degree declining 20. Does that make sense? So you weren't supposed to do this one here short. Once it worked, then you can do every single one after that. Here, even here. As long as you put it on the other side of the 20, it's fine. You don't get stopped out. Right here, and I don't know where it closed. And it closed at the low of the day. See that? And this is not necessarily the best example I've ever seen, of course. It isn't. It wasn't. But this is just something that came up that Jason brought up just a minute ago. So under the last bar's low, that gets close to the 20 MA. Okay? If it's not very close to the 20 MA, go ahead and pass on it and catch the next one. Look to catch the next one. And if you're still not sure, it's very sloppy, like this one is pretty sloppy, just fall in and put your stop on the other side of the 20 MA and should be fine. You should be fine. Okay? It takes a little bit of conviction and trust, and once you do it successfully with ease, guess what? You start to build some confidence. So you do it today, you make a little bit of money on it. Tomorrow you have a little more confidence, and then you do it again, and now you have a little more confidence. And sure enough, after a while, it becomes second nature to you. It becomes what you do. It's just what you do, right? Wasn't there a Geico commercial or some kind of commercial? It's just what I do, or something like this. So it becomes actually something that you don't even think about. It becomes second nature to you, and you don't even think about it. A lot of the things that I do, I don't even think about. I only verbalize them. I only talk about them because I'm on the mic. Otherwise, I don't really often think about it. I just know it. I know and I do it, right? I just know what I'm supposed to do and I just do it, right? More examples. When you have the railroad tracks, it just doesn't fail. When you have railroad tracks, it rarely fails. Rarely fails. Okay. And then the sideways trend is defined as a series of relatively equal highs and lows. Sideways trends are also known as stages 1 and 3. Stages 1 and 3 in that basic unit, which we'll talk about next week, in next week's lesson. Now, the note that T3T's objective is to buy the lows to the prior low and sell short the top. Buy the lows, sell short the top. Okay? Now, having said that, if it's a stage 1, so never forget this basic unit, the 4-stage cycle. Okay? Never forget this. This is stage 1, and that's stage 3 at the top. What comes after stage 3 is always a downtrend, always stage 4. But for a while, it's sideways. For a while, it's sideways. What comes after stage 1 at the bottom is always a stage 2 uptrend. So because of that, we say in a stage 1, the T3 trader is more prone to buy the dips than sell short the rallies. In a stage 3, the T3T should be more prone to selling the short the rallies rather than buying the dips, because eventually it will break to the downside. It should break to the downside. Okay? This is a picture of a sideways trend. Not really particularly that clean or that good. When it comes to a sideways trend, I'm not trying to overwhelm you with information, but notice how the first two were not circled, the first two pivots. So it takes two pivots, so two equal pivots. They don't have to be exactly equal, but just in the same area before you can call something a sideways trend. And then every other pivot you can now do long, short, until it fails. So 1, 2, 1, and now the third one, short, long, and now that's this. So here 1, 2, the third one, long, short, long. If you did it long here, it wouldn't have worked, but here it worked. Long, short, long, short. Eventually, notice that it broke out. So this, right? This must have been a stage 1, not a stage 3. Because if it was a stage 3, it would have rolled over. The fact that it eventually broke out was probably stage 1. Or it was already in an uptrend and just went sideways for a while. Right? Went sideways and then eventually broke out. Kind of like Boeing. Right? Let me show you Boeing on, we were talking about Boeing today and why I don't think it's a long, right? But let me show you Boeing on maybe the monthly chart. See how it was sideways? It was a sideways trend, but in a larger uptrend, and then eventually went higher. So that might have been the case here. Notice the oscillator below. Do we need it? Is it of any use? No, it's not. It truly is not of no use. Sideways trends also, even if you don't want to trade them, even though I know how to do it, I'm teaching you how to do it, and I don't do it personally. Because you don't want to be the jack of all trades, master of none. You want to focus on what really makes good money. For me, sideways trends, for the most part, they're not very lucrative, and they're hard to find, the really good ones. So I stay away. But the good thing about sideways trends is that they signal that the stock is either ready to reverse or explode higher again. So, you can basically get your staging figured out. When it's in an uptrend, it's in a stage 2. So it becomes a matter of, is this a stage 3 or is this a continuation? Remember the lecture that we did today in the room about how to figure out whether it's a continuation or a reversal? Remember that? This was a reversal base. And so this was stage 3, and then it broke down, resulting in a stage 4 downtrend. This is a better sideways trend because it's cleaner. So again, the first two pivots, so the first one, second one, don't do. because you don't know it's sideways until you get a double top. The third time and every other time after that, you can do it short, 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 short. The first two, 1, 2, don't do because you don't know that you didn't know it was going to bottom, double bottom. And then every other time you can buy, buy, buy. And here we can see that it broke out and probably continued higher. That was the end. But look, you can always look for, the market always gives you clues, almost always. Look at it here. Check this out. Every time it went back to the prior high, it used multiple bars up, which means it exhausted itself, and then it came back down. Up, multiple bars, multiple bars. Look here. In one bar, it retraced about 80% of the prior move. So that was already should have been your tip that it might be going higher. This time there wasn't going to be an entry and a short. Does that make sense? So in one, look at the size of the bar. This was an igniting wide range bar. You might say, what about this? Wasn't that? No, it wasn't because it came after multiple bars up and then a wide range bar. That's more exhaustion. In this case, higher low, higher than the prior lows, right? But also a wide range bar that retraced, reversed 80% of the initial move. So this was indicative that it was going to go higher. But the beautiful thing is, I don't think it even triggered short. It never set up as a short. Does that make sense? So that's how you play a sideways trend. Having said all of that, sideways trends are not the easiest. So you don't actually have to do it. You don't actually have to do everything. This is an uptrend. Notice how the pivot highs, the A through D, and the pivot lows, signified through the numbers 1 through 6, are all consecutive. Consecutive higher highs, consecutive higher lows. The rising 20, the rising 40, and the railroad tracks between the two moving averages. When you have that, every single pullback, every single breakout becomes playable. And that's the downtrend. Lower highs, lower lows, declining 20, declining 40, and even space between the moving averages. When you have that, every single pullback, when I say a pullback, I mean a counter rally, is playable short. Every single breakdown, if you get a base breakdown, is also play as long as it's right off the 20 MA, as close to the 20 as possible. And then a sideways trend, we just talked about it. Okay. When pivots are not consecutively higher or lower, it forms what is known as a sideways trend. Okay, everybody, that was the lesson for today. Just want to let you know, in case you're not aware, that we have an incredible offer going on right now where you can join me in the Strategic Day Trader Room and take advantage of the earnings season, the upcoming earnings season, which, as I said, is starting on Thursday, starting this Thursday with the banks reporting. For the next 30 days for just $49. For just, I mean, this is free, almost. I don't want to say free because then you're going to quote me and say, hey, Sami said it's free. But to me, this is almost free. Everything costs more than $49 these days. What you learn is you get a simple and accurate system, just like what we were talking about, how I keep it simple, but it's powerful. A simple and accurate system that's designed to teach you how to trade with a vision that's clear and unclouded by emotions. You learn multiple proven strategies. Those are the things that I do. Gaps, climactics, the 15-minute chart in the afternoon, earnings, level 2 scalps. You'll get to see all of that. You'll get to see all of that in the next 30 days because we have earnings season. So over 18 chart patterns is what I know and do. Stock and cryptocurrency trades. When there's a setup, today I gave 2 entries for cryptocurrencies. Neither one has triggered yet, but the plays are open. I mean, the orders are in the system. If they trigger, I'll be in them for Bitcoin and Ether. And you get a simple and accurate management system, and of course, powerful entry tactics for maximum gain. All of that can be yours, basically, more or less, if you join me for the next 30 days in the Strategic Day Trader Room. Truly the best room, actually won the best room for 2 years in a row when they were running that contest. Voters traders voted on the best room in the nation, and my room, the room that I'm in, I don't like to say my room. I'm not the only one that's in it, of course. It's the community also. It's the my co-moderators. It's everybody that makes it up. We won 2 years in a row as the best trading room in the nation. I'm not making a claim like this. That actually did happen. I'm not just saying, oh, my room is the best. Believe me, it's the best. No, this actually did happen. So feel free to join us for the next 30 days. There is a link in the description of this video just below. So check it out. And if you have any questions, reach out to customer service. Their contact info is at the bottom of the page. Thanks so much, everybody, and have a good night. Take care.